So in this question, we have big enterprises. They had the following trial balance activity as of December 31, year 5. Now we just need to figure out what they would report as current liabilities in the balance sheet. Right? So there's other questions like this where we just need to figure out how we would map trial balance accounts to our balance sheet. And this is a very common exercise that is done each time the financial statements are presented, right? How do we take individual trial balance accounts and map them to our balance sheet that's included in our financial statements, right? Because we need to make sure that these trial balances accounts are properly presented. So when we think about current liabilities, that is debt or short-term payables that the company must pay off in the next 12 months, right? So if it's greater than 12 months from our balance sheet date of December 31, year 5, it's going to be non-current or long-term. So let's go through each option. The first one says prepaid expenses of $9,000. This is one that always confuses candidates because prepaid expense, right? It sounds like something that I'm going to have to pay off in the short term because it says expense. But in reality, it's when the company gives cash to another company for a benefit they're going to receive in the future, right? They are prepaying an expense. It's like if you paid your rent the month before your rent is actually due, right? The landlord can't recognize that rent as revenue yet, but they already have your cash, right? So for you, that's a prepaid benefit, and that's going to be part of the current assets section of the balance sheet. So go ahead and exclude that. How about the allowance for doubtful accounts? Well, we typically attach this to accounts receivable, right? And that allows us to state accounts receivable at net realizable value. Now, the key thing to remember about allowance for doubtful accounts is that it's a contra asset. So it's not going to necessarily be included in current liabilities, but it's similar, right? In the sense that it decreases, it's negative, but it's not part of current liabilities, which is what we need to solve for here. So we can exclude that, right? It's part of current assets. How about current deferred revenue of $2,000? Well, deferred revenue is a liability and it tells us it's current, so we know that. Right? And deferred revenue is when our customers pay us in advance for services they're going to receive over the future, right? So if we got paid by our customers for services that we're going to need to perform next month, right? We can't necessarily recognize that revenue, but we have their cash. It's a liability, right? So it's going to be current. It's going to be a current liability. So include that in our table. How about accounts payable of $3,400? Well, when we receive an invoice from a supplier or vendor, right, we record that in accounts payable. Typically the terms are 30 days or maybe it's due in 45 days. It's almost always short term, right? Why would our suppliers give us a year to pay off our debts, right? So accounts payable by nature is always going to be a current liability. And then this last one is income taxes payable of $3,000. Well, when we owe money to the government, right, that's income tax that we still have to pay, right? We haven't actually paid them yet. Now, do you think the government wants to wait 12 months for us to pay them? Heck no. They want us to pay them as soon as possible, right? So by nature, again, income taxes payable is always going to be a current liability. So the only items we would include in current liabilities would be current deferred revenue, accounts payable, and income taxes payable, and that sums to total current liabilities of $8,400. So that's the correct answer.
What's going on? My name is Joey, and I'm the founder of Universal CPA Review. You're probably here because you're ready to pass the CPA exams once and for all so that you can advance in your career and move on with your life. Let me be the first to tell you that I've been there and I feel your pain. But I'm also here to tell you that the CPA exam doesn't have to feel like such a maze, and there is a path to a passing score. So what are you waiting for? Don't waste any more time. Commit to the process because it will pay off. In my opinion, I say let's knock out the CPA exams once and for all.
So when it comes to the balance sheet, right, we learned in the lecture that there's different ways that we need to present the items and how we would do that, right? And ultimately, this question is asking about, okay, if we had to reacquire something at today's cost, well, what is the name of that reporting concept, right? And that is known as current cost, right? If we had to go out and buy it, what will we have to pay today? Another term for that is replacement cost. So it could be this similar to fair market value, but the term we're looking for here is current cost. So that is the correct answer. So in this question, we basically have Green Sports Company, and they received an advance payment for special order tennis shoes from a customer. Right, so they haven't actually manufactured the shoes yet, but they plan to, and then that order will be delivered in the next 6 months. So for Green Sports Company, we need to think about how they would record this advanced payment on the balance sheet, right? Because they've received cash from their customer, but they haven't actually performed any product yet, right? So there's this obligation, and that represents a liability, especially since it's going to be in the next 6 months, right? So that's a current liability. Now we'll talk about the mechanics of this in later modules, right? But at the end of the day, when we receive cash in advance from a customer, and then eventually we're going to go ahead and deliver the product to that customer, then we can recognize the revenue, right? Well, if we receive cash and we can't recognize the revenue yet, that is called the deferral of revenue, right? And since it's within 6 months, it's going to be a current liability. Right? So when we look at our mental map, our balance sheet, we can see deferred revenue is under step 3 for current liabilities, right? So we don't see deferred revenue on here, but we do see current liability. And so that's how this advance payment would be represented on the balance sheet. So current liability is the correct answer. So in this question, we have Poof, and they are preparing the balance sheet for the company's annual report. Now, at the end of the day, we have to remember the basic formula for the balance sheet, right? As it implies, the balance sheet must actually balance. But what does that mean? Well, as you can see in the visual, assets must equal liabilities plus equity, right? That's the only way the balance sheet can balance. So on the top part for total assets, we have $150. Well, that means that if we add the liabilities and stockholders' equity, it must also equal $150. But that's the only way that a balance sheet can balance. If it doesn't balance, then we have an unbalanced balance sheet, and that means there's an error somewhere. Now, this is just the basic fundamentals of accounting, and we have to get this right in order to be ready for the rest of FAR. Now, since this question is only asking for the correct formula for the balance sheet, take a second, ingrain this in your head, and just remember that assets equals liabilities plus shareholders' equity. So that's the correct answer.
Okay, so thinking about Garson Co., it looks like they recorded goods in transit purchased FOB shipping point at year end. So they recorded this as purchases, and that's important because it's going to dictate if they should have recorded the transfer of inventory for financial reporting purposes. Okay, so they're buying this inventory. At what point should this be reported as inventory in their balance sheet? And if it's FOB shipping point, the transfer of inventory should have occurred at the date that inventory is shipped, right? Not the date that it has reached its destination. That would be FOB destination. But again, this is FOB shipping point, so we know that the goods were excluded from ending inventory. That means that ending inventory is going to be understated. All right, so we want to know what effect is this going to have on assets and retained earnings at the end of the year. Okay, so because they were shipped FOB shipping point, then they're going to be Garsons at the point in which they are shipped. All right, but because they excluded them from inventory, this is going to do what to assets? Obviously, assets are going to be understated, right? We should have recorded that as inventory, but we didn't. Okay, so what's it going to do to retained earnings? This is a little bit more challenging to think about. We have to ask ourselves, what impact is this going to have to ending inventory? Well, we know that ending inventory is going to be understated. And now we need to ask ourselves, how is ending inventory going to impact cost of goods sold? Right? Ultimately, this has something to do with net income, which has something to do with retained earnings. So if ending inventory is understated, that means cost of goods sold is overstated. Okay, so if we say that we have less inventory on our books than we actually have, that means we over-recorded cost of goods sold. So if cost of goods sold is overstated, net income now becomes understated. All right, so at the end of the day, retained earnings is going to be based off of net income. Retained earnings is the amount of net income that is not distributed. Okay, so maybe they're making distributions as dividends to shareholders. Retained earnings is the portion that wasn't distributed as that dividend. All right, so if net income is understated, retained earnings is always going to be understated. Okay, so because of this hiccup by Garson Co., both assets and retained earnings are going to be understated.